You know that feeling, right? Trying to figure out which way the market's going, all the ups and downs, and you just wish someone could, I don't know, lay out a clear strategy.
Yeah, it can feel pretty overwhelming.
Well, that's kind of what we're trying to do today. We're going deep into a recent stock market analysis, really looking for signals that might suggest where things could be heading.
That's right. And we've got some interesting source material here. It's a YouTube video from the AR-AMR Report.
Ah,
The
yes.
title is Stock Market Investing, Time to Buy Stocks, Part 2, and then a bunch of ticker symbols, SECUY, QQQ, SECUQ, ISP, IWM, AMTMR, KK. So, it already kind of hints at their take.
Time to buy stocks, definitely a perspective.
And what's cool is it's framed as a look inside their virtual hedge fund morning meeting, so kind of a real-time discussion.
Right, like being a fly on the wall while traders figure things out.
Yeah.
So our mission here is to pull out the key ideas, understand their thinking, and hopefully give you a clearer picture without, all the super technical jargon.
Okay, so let's get into it. To understand where they are now, we kind of need to know where they've been.
Context is key.
Yeah. The presenter kicks off by talking about a previous market collapse. Their words that they say their algorithms, their algos, help them handle well.
Algos, right? The computer trading rules.
Exactly. They specifically mentioned their risk monitor was flashing red back in February.
Red meaning danger, basically. High risk.
Pretty much. High perceived risk, likely meaning they were playing defense, holding back.
Okay, so they felt their system flagged the earlier danger.
Mm.
Now, the big question is that changing? Is the monitor shifting?
That seems to be the core of it. The video title hints at it, and they mention the monitor might be moving towards yellow.
Yeller meaning caution, but maybe start dipping a toe back in.
Yeah, caution, maybe put some money to work. And a big signal for this potential shift is something they call trade number 21 on the S&P 500.
Trade 21. Okay, what's special about that?
They describe it as their most sensitive algo for swing trading direction. And it apparently triggered just 2 days before they recorded this video.
Ah, so very recent. And did it work out?
Well, they seemed quite positive. They mentioned phenomenal follow-through the day after it triggered. But maybe even more telling is how their system handles the risk.
Risk management, right. Always important.
Yes. So the price moved up enough that it automatically triggered a raise in their stop loss, pulled it right up to break even.
Oh, interesting. So very quickly, the worst case on that specific trade became just not losing money.
Exactly. On their most sensitive signal, risk off the table fast. It really shows how focused they are on controlling that potential downside.
Okay, so they have this signal, this trade 21, but they don't just rely on that, do they?
No, and that's where it gets interesting. They bring in a historical comparison. They look back to the year 2000.
2000. The dot-com bust, that sounds ominous.
Well, yes and no. They specifically look at the NASDAQ Q100 index after it had that huge 40% drop in March 2000. And despite that massive fall, the presenter points out that the market rallied all summer right after that.
Huh. So even after a crash, you can get a significant bounce back.
That's the point they're making. The comparison isn't about predicting the exact same thing, but showing it's not strange, as they put it, for the market to try and build a base and even rally after a big hit. What we're seeing now, this attempt to stabilize, isn't necessarily, weird.
So it fits a historical pattern, potentially. It's not just the charts and algos then. They're also looking at the bigger picture.
Yeah,
News and sentiment.
definitely. They talk about the news cycle potentially shifting.
How so?
Well, they talk about China maybe reducing tariffs on U.S. goods. That could ease some worries, right?
Sure, that would be seen as positive.
And they also bring up potential trade deals Trump mentioned with India, Japan, South Korea.
Okay, so a few potential positives on the horizon, news-wise.
Yeah, the idea seems to be that maybe the constant drumbeat of negative news is starting to turn, or at least pause.
Right. So you've got the algo signal, the historical echo from 2000, and maybe a more positive news flow. What does that mean for their strategy now?
Okay, so this is where they talk about potentially getting aggressive.
Aggressive, like going all in.
Well, aggressive within their system. It's crucial to understand that. They're very clear. It's not like they have a crystal ball. They call it a probability algorithm.
Meaning it suggests probabilities, not certainties.
Exactly. They know they could still lose money, even with these signals lining up. They actually stress that the start of a new risk-on cycle can be the shakiest part.
So they want to get in early, but they know it's bumpy.
Right. They're trying to catch that early momentum, but they fully accept the risk. They even say they're prepared for the market to crater even after they put money in.
That takes some conviction. Or maybe just good risk planning.
Probably both. And that leads straight into how they manage that risk, specifically position sizing. They call it the absolute key to success right now.
Okay, how do they figure out how much to put into a trade?
It's surprisingly visceral. They say you calculate your potential loss down to your stop loss point.
Right, the maximum you could lose on that specific trade.
Yeah. And then you ask yourself, if you look at that dollar amount written down, does it make you want to throw up?
Huh. Okay, a big graphic, but I get it.
If the answer is yes, the position is too big for you personally. It's a gut check, really. Can you handle that potential loss without freaking out?
Makes sense. Keep the fear manageable. So let's talk specifics. What are they actually doing with their money based on this? They mentioned different funds, right?
Yes. First, their flagship fund. This seems to be a bit more diversified, maybe a bit more cautious initially. The plan there is to add to broad market ETFs, exchange-traded funds. They mention the S&P 500 ETF, which is ticker SPY.
Standard stuff.
Yep. Also a momentum ETF, MTUM. And something that they just called a bug ETF, which usually implies, innovative tech or growth stocks, maybe like a Vanguard growth ETF or something similar.
And the others?
And interestingly, given some market talk, they're also looking at adding to ARKK, the ARK Innovation ETF.
Ah, Kathy Wood's fund. Okay. Why ETFs mainly in this flagship fund?
Seems like it's about avoiding single stock blowups, right? And it makes it simpler to just pull back exposure quickly if the market turns ugly again. Easier to sell an ETF than unwind a dozen stock positions, maybe.
Good point. And this is adding to other things they already hold.
Yeah, they mentioned these potential adds are balanced against existing holdings in things like precious metals, Bitcoin, dividend stocks, so it's still part of a diversified mix.
Okay, that's the flagship. What about the other portfolio they mentioned, the growth one?
Right, the ARMR Innovative Growth Portfolio. This one is more focused, individual stocks here.
Okay, which one's caught their eye?
They listed off a few they've added recently. Roblox, Palantir.
Gaming and data analytics.
Okay.
Right.
Coinbase, though, they said they were adding to a position they already had there. DocuSign, CrowdStrike, and Uber.
Quite a mix of newer tech and established players. CrowdStrike.
Mm-hmm.
Is that security?
Yeah, cybersecurity. And they made an interesting note there that CrowdStrike is actually a top holding in that momentum ETF, MTUM, not so much in ARKK. Shows they're paying attention to the details inside those ETFs.
Good catch. Okay, so they're adding positions. Are they doing anything to protect against downside? Hedging?
They do mention it. They say they'll be heavily focused on hedging the new risk they're taking on.
But they don't say how.
No, seems like the specifics on the hedges are kept for their paid subscribers, their ARMR insiders.
Gotcha. Okay, so let's try and wrap this up. What are the main takeaways from this deep dive into their thinking?
Well, first, there's this algorithm signal, Trade 21, suggesting a potential shift. Then they back that up with a historical look, comparing now to the post-crash rally in 2000.
Right, the idea that a bounce isn't unusual.
Exactly. Plus, maybe a more positive turn in the news cycle, all leading them to get aggressive.
But aggressive within a defined risk framework. Position sizing is key, that gut check.
Absolutely. And then the actual moves, using broader ETFs like SPY and MTUM plus ARKK in one fund, and picking specific growth stocks like Roblox, Palantir, CrowdStrike in another. And importantly, planning to hedge that new risk.
It's a fascinating blend, isn't it? The quantitative signals from the algos, combined with that historical context, the news flow awareness, and then overlaid with strict risk rules.
Yeah, it really is. And it makes you think, doesn't it? How does this specific approach, interpreting signals, managing the risk, how does that resonate with how you make decisions, whether it's investing or, something else entirely?
That's a great question. What signals do you look for in your own world, your own areas of interest? How do you decide when to act and how much risk to take?
Something to ponder.
Definitely. Look, this deep dive gives you one particular view, one methodology from the AR-AMR report for navigating these tricky markets. It's not the only way, of course.
Absolutely not.
So we really encourage you to take these ideas as, food for thought, a starting point for your own research and learning. Keep seeking out different perspectives. That's how you build a truly robust understanding.